Good evening. I'm Michael Bender from the Center for Fiscal Equity, and this is a backgrounder on tax reform for members of Congress, their staffs, especially on the revenue committees and the budget committees. That would be, the revenue committees are, of course, Ways and Means and Senate Finance. So I bombard them with comments for the record and include the plan, but it's probably useful to see it in a production as well, or a production video as well. So let's get to it, as we say on YouTube. The first element I have, because it's the most direct one that people will see, is individual payroll taxes. That will still be on the check. Not much else will be on the check for in the event of tax reform. It'll be 6.5% of employees from $16,000 to $85,000. After which time it hits its ceiling. Why the lower ceiling, you ask? Because the higher the upper limit is, the more benefits go to people who don't really need them. This is about aside from kinking the curve, this is means testing, or rather, it's just means testing benefits, essentially. So it's means testing on the accumulation side. So now this seems like it would be a disaster, but this is the employee side. The employer side would be paid for by different revenue sources. I'll discuss those below. They being probably in a second video, the invoice VAT and the subtraction VAT, which is essentially a tax, the taxes that employers pay on behalf of their employees, but in a subtraction VAT, you wouldn't have the employees actually file. The employer would file the taxes that they now just collect. So with various credits and things, we'll get to that. Anyway, the subtraction VAT or the invoice VAT, those monies collected, because they can't really be assigned to an individual, will be assigned equally on an equal dollar basis to anybody who works in that quarter, who works full time, or who works the minimum amount of hours in that quarter. So if you work a few hours, you're not going to get anything out of it. But if you work enough to have that quarter count, then you would get a chunk of change for later. So in fact, if there's any kind of personal retirement account in the future, you would have to do it this way, because the current system gives a basic amount, and it's fairly progressive, and you would have to have that progressivity be in the accumulation side rather than being on the reward side, or on the payment side. Because if you take it away from the payments, because if you have personal accounts, then the progressivity kind of unravels. So you've got to then add it at the beginning. So but because people would object to having no relationship between the level of earnings and the benefit, you would leave in a payroll tax that's income sensitive. Now, I would be perfectly happy to take out the individual part and have just equal crediting for each worker, and then have personal retirement accounts that own employee stock. But again, we'll get into that later. But this is part one. Again, the rate is 6.5. Now this gets us into wage surtaxes. And the wage surtax would pick up and still be 6.5 where the payroll tax leaves off. So for the first $160,000 of income for an individual, because there wouldn't be any family taxes anymore. That would be the rate would be a consistent 6.5% flat tax, which means there would be other taxes, but everybody would pay something, guaranteed. So now that after another 85,000, then the tax goes up to, for that money after that becomes 13%, and they would still take they would of course still pay the 6.5% for the second tranche, and of course the 6.5% for the first $85,000. So, and then $85,000 later, you'd add another 6.5 to the rate, and you would keep going to the top rate would be 52% at $680,000 or $680,000, and there's an option in that, and the option is to have subtraction VAT, which I'm going to talk about probably in the next video because this is going to take a few videos to get through. The employers would simply take the salaries that they make under $330,000 and above, or $340,000 and above, and tax those between 6.5% and 26%, with 26% for all salaries paid to an individual over the $340,000 cap, and that's on all salaries that they collect or that they pay out. So instead of collecting them and then sending a bill or a W-2 to the individual, they would just simply collect that on their salaries and not bother the household or the earner with having to file. Now this takes, if you do it that way, this takes everybody making under $425,000 off the tax rolls, which is not a bad idea, I would think, at least as far as salary goes. We'll get into other forms of taxes next, but yeah, and we know where Social Security taxes go. Where do these taxes go? These taxes, the surtax would pay for interest on debt, war, or overseas deployments and naval deployments, and especially, the satisfaction of the Social Security Trust Fund, because it's in the surplus, and people of my generation paid a higher payroll tax so that we would have enough money in the fund to retire. And I plan on having that money without having to pay more taxes, because I've already retired anyway. But that nobody else should either, especially because here's the thing about Social Security. There's the conservative balance, fund balance, and there's the realistic fund balance. All the talk about a fund balance that's out of whack is with the conservative balance that they're required to report to. If you take the realistic balance, it's not going to run out of money ever. But they can't say that, or they can say that, but the law requires that they show the conservative picture, which is there's a cognate to that in pension. In pension accounting for full funding, and that's why pensions went away for a lot of the private sector, because the people were saying, oh, you've got to have it be fully funded. Well, you don't need to have a fully funded pension. It can be pay-go with some amount of reserves. The requirement that pensions be fully funded, this is an aside, of course, is an excuse to sell defined contribution plans instead of defined benefit plans. In other words, it puts people on the hook for their retirement, which people can certainly save, but a lot of people can't. Like 80% of retirees can't. They don't have enough income. It wouldn't be a problem if everybody had enough income to save, but they do not. So we'll talk about that later too. So that's this piece. Veterans benefits would also be paid for by wage surtaxes, let's see. The something I wrote that about OASDI employer funding, but that's I'll ignore that for now. I'll read it. Transferring OASDI employer funding from existing payroll taxes would increase the rate that would have to be collected because people aren't getting their gross; they're getting a lesser amount in their net because they're not getting withholding. They'll get a smaller gross, but they'll keep most of their net. So that's why it's a 6.5% rate rather than a 5% rate, which is what it is now. So that's the second part. I think I'll end here and go to another piece, just because that piece is going to take more than 4 minutes to talk about because it's fairly advanced stuff. So we've covered wage surtaxes, and we've covered Social Security payroll taxes and just general Social Security funding, at least part one of it. I will continue with asset VATs and maybe subtraction VATs in the next video. As usual, there's a description in the chat, or in the description has. Yeah, there's no chat. The description below has the links to the tax reform plan, to other videos that are related. It will be linked to more often than being linked to. And of course, for those of you who are not congressional staff or members or senators and their staffs, this is a Patreon link. So, please support the channel, please like, please save. I'm trying to find a way to get this tax plan out there for maximum exposure, and it seems that YouTube is the way. So, again, join me for part 2. The link will be in the description to keep going. Thank you very much.